There's been ample discussion about the overarching themes that determine what makes Africa an attractive business opportunity for people in the private equity industry. But there's been less of a look at the detailed considerations that go into the decision-making process of a limited partner who is either considering to get into the African market or already active in the African market. Paul Tierney, himself a veteran investor on the African continent, chaired a panel of several investors who are either looking at the continent or who have extensive experience in the continent in discussing what exactly goes into making the decision to get into Africa.
What I would say is we look for the same things we look for everywhere else, because we are very much sort of bottoms up, in terms of our selection of managers, and we choose on the basis of teams. We don't take a macro view that we need exposure to Africa or Europe, etc. I mean, in theory, and I say this purely in theory, we could have in any given year all of our commitments be to European funds or to African funds, etc. So we really find teams that we think have an opportunity set that is compelling, which we think there is in Africa, but they have a unique tool set to access those opportunities. And that's very important to us. And as I say, that has to stand up to an opportunity that's in Boston or an opportunity that's in Bangalore.
I would agree very much with Mona about our approach, which is a team. You have to fall in love with the team first, as part of an allocation strategy, which is very flexible. So in that context, as a primarily proprietary investor, we are not seeking to try and give LPs coverage of geographies by having to be in every continent. So at the end of the day, continents or geographies compete, and they are, for us, a matter of relative attractiveness. Maybe I'm the only one on the table that hasn't yet committed to Africa Fund, which means it's a good testimonial to have me here, because it's a question of when will we do so and under what circumstances, and probably by the end of the next 12 months we would have done something. So it's a question of how attractive macro-wise is a country in Africa compared to Brazil, compared to China, compared to India. And within that context, if a team can really demonstrate what we believe is necessary, which is the track record, the local knowledge, and all the tick boxes that you all know about, this is what would make us tip over and actually do something.
We made our first commitment to an African fund in 1996. And to take a step back, agree with a number of things that the panelists mentioned. One of the things that you're hearing as a common refrain is that, I think as Carlos said, capital will be competing. There's nothing that enables or suggests to an institutional limited partner that they have to be in Africa if they have an opportunity cost of €1 or $1 to deploy anywhere else. Second thing that I or we have learned over time is that investing in emerging markets and private equity is, of course, all about return relative to risk. And the proverbial outsized return, given that you're dealing with outsized risk in emerging markets, works in theory, but frankly, it doesn't always work. In fact, it quite rarely works in practice. To be blunt, we have, with some fund manager commitments that we have made, not so much in Africa, I'll come back to the moment, but elsewhere in emerging markets, we've had our heads handed to us. Because the reality is it's damn hard to make money in a lot of emerging markets. We have found that minority investing in emerging markets is usually a recipe for trouble. That what you're looking for is either outright majority control of assets, and or if you can't get majority, you have to be in a strong controlling position with significant negative control provisions within an Articles of Association or within a sale purchase agreement. We have to have, similar I think to what Mona was saying, you want to combine that macro level understanding of infrastructure with a very clear belief in the micro capabilities of the team that you're backing. We have been fortunate in the African context to make a couple of I think, very good decisions. We've been backers, groups that I'm sure are familiar to this audience, such as Brait and Ethos, going back to that 1996, 1998 timeframe, and have stayed with those organizations since then. Those managers have, notwithstanding quite a bit of turnover in their team, have consistently attracted and nurtured top talent, which has been helpful in generating returns, which by emerging market standards I think are very, very good, and frankly by most standards in our portfolio are also good compared to Europe or compared to the United States. So a bit of a long-winded answer, Paul, but experience has shown us that you can absolutely make money, but you have to be extremely careful, you have to be extremely diligent and close to the action on the ground, and it is still not for the faint of heart.
Well, Peter, on the minority investment danger that you flagged, let's talk specifically about Africa. What is the problem with being a minority investor? Are you worried about your ability to change, or the fund's ability to change management, or are you more worried about control from the standpoint of not being cheated, of corporate governance, the things that you can?
I think it's probably both of those things, Paul. I think the critical thing, though, is when you are the controlling shareholder of a business, you have the ultimate capability to deal with any aspect of the business that needs strengthening or needs improvement. That may be management. That may be strategy in terms of whether to expand to other African nations and or take advantage of competitive position to expand broader into international markets. It might be relationships with banks and how you control and or control cash, but also how you deal with the kinds of terms and conditions on working capital, capex, etc.
Why bother with private equity? Why not have exposure through liquid securities or index funds in a region or a particular country?
You know, the fact that they're, of the 53 countries in Africa, I think there are only 26 countries that have a stock market, and even then, liquidity in these markets are fairly low, as we had discussed. So, if we wanted to increase our allocation to Africa, given this fairly bullish view, then for us it is, we cannot. I mean, we're up to our commitment in terms of liquid securities. It makes sense for us to now look at private equity, and there, I would say it's something that we continue to think a lot about. And there, again, as the comment was made earlier, there are something like 300 private equity funds in India, but there are a handful. There are 20 to 25 managers that focus on Africa, and I think there we're doing a lot of work, really trying to understand who will be the kind of top quartile, top decile managers over the next 10 to 20 years.